But this is the Financial 15 segment of our weekly webinar, and this is a continuation of what I started last week. And if you haven't seen that, you can go to part 1. And if this is the first time joining us on the Financial 15 or on this YouTube channel, you can hit the like, subscribe, and notification buttons so that you always receive notifications of our upcoming videos. And we do break these into different segments. So this last segment is usually about 15 minutes or so. Sometimes it goes a little longer, and if that's the case, we'll break it down. But this discussion about financial education or essential items for younger adults, college students, and young adults really came from a presentation I was asked to give at a local college about financial literacy. So you've heard me say this if you started with us in the beginning, but I was really inspired by some of the feedback and some of the questions I got from the students in the class. And I was really motivated as I was putting this presentation together and some of the conversations I had with my own kids. So I thought I'd share it with you. And if you're a sophisticated investor, you can share this with people you love. And if you're a young adult just learning for the first time, I'm happy to share this with you. But this section is called Grow Your Money. So we talked in part 1 about banking and the fees involved with banking, and so I'm talking about account fees and the interest rate that you can earn in banking with your deposits, when you put money into a bank and the different options that are available to you, money market CDs, things like that. And I always stress, get as much interest as you can when you're talking about your deposits. Be careful and know when you're going to need those funds, but get as much interest as you can. And then when we're talking about debt, whether it's credit card debt or some kind of loan, pay as little interest as you can and be really, really careful with that interest, because it can absolutely just steal all your money away. And I just referred to it as stealing your money away. And it's really important to know what you're paying for things, the total amount of cost with the debt cost. It's really important. And of course, those account fees can chisel away at your money as well. But now we're going to talk about how to grow your money. And in this first section, we're going to talk about stocks. So what is a stock? And the analyst reports that we were just going over in our weekly webinar, I was reading these analyst reports, and some people say they should overweight stocks in different parts of the world. And some other analysts say we should overweight bonds in different parts of the world. And we talked about, kind of how to work through that information and that muck. But the basics are, what is a stock? How do you grow your money, and what does it really mean? And when I asked this question, there was a fellow who, a student who raised their hand, and they said it's a partial ownership in the company that you invest in. And short answer is yes, that's exactly it. A stock represents a share in the ownership of a company, including a claim on the company's earnings and assets. As such, stockholders are partial owners of the company. So not a recommendation to buy, sell, and hold, but if you really love Apple, well, you can be owner of Apple. If you really love Google, you can be a part owner of Google just by buying the shares. And it's never been easier than it is today. When I was in my 20s and I wanted to buy a stock, I think it was America Online, if you remember AOL.com. I reached out to a broker, and I had to have a certain amount of money, and I couldn't buy it online because that was just starting. It was a bit of a process, and you had to have a good chunk of money to invest. And I remember the broker I reached out to, my mother-in-law, who works with us now, actually worked for him at the time. He said, "Mark, I'd love to put together this different portfolio for you over time, but you're really better off just buying a mutual fund." And we're going to talk about mutual funds and ETFs at our next segment, our next week. But it is so much easier now. You've got platforms like Robinhood and, all these different, I was about to say TD Ameritrade, but Schwab bought TD Ameritrade. So you got things like Robinhood where you can, and I'm not recommending Robinhood, but you can buy fractional shares. You can set up an account easily online. So make sure that you have a strong custodian that is going to has good reputation, that isn't going to disappear with your money. But it's much, much easier today to buy stock, and you can set it up online, and you can buy it. When I say cheaply, I don't mean the price of the shares. I'm talking about, for a few $100s or less, you can start investing in stock. So when the value of the business rises or falls, so does the value of the stock. Makes sense? And there are two different ways to grow your money in stocks. First of all, we have dividends. Some companies pay dividends. And some companies don't, and you're just subject to the price increase or decrease. So you can grow your money by either dividends and or price increases. This, when you're talking about stocks or even bonds, for the most part, this is longer term money you're not afraid to lose. Certainly when we talk about bonds, and that's next week, but when we talk about bonds, that's also money you're not afraid to lose, because the bond market can be very, very volatile. But of course, with stock, listen, we've had some great growth in the stock market. Different companies have grown very, very well. I'm going to show you some examples in a moment, but there are companies out there. I use the example of America Online. They really don't exist anymore. So if you invested a lot of money in America Online, it's likely you have none now from that investment. I actually don't. Is there any iteration of AOL that is still available? I just don't know. So you're going to see some disclaimers on the bottom of every one of these slides, and it's just in case I forget to say it, but stocks also have a risk of loss of your investment. So you can gain quite a bit, or you can just gain a little bit, or you can lose also. And you can lose everything. There is no protection in individual stocks. If a company goes out of business, goes bankrupt, then you can lose all your money. So General Motors is a really good example. You can still buy GM cars, right? So Chevy, General Motors vehicles, but during the Great Recession, right, the financial crisis, General Motors filed bankruptcy. So if you had a significant amount of money in GM, you lost it all. So again, long-term money you're not afraid to use is what you should be looking at for your stock investments. So let's first talk about dividends. A dividend is the distribution of a company's earnings to its shareholders and is determined by the company's board of directors. Dividends are often distributed quarterly and may be paid out as cash or in the form of reinvestment in additional stock. So you can choose to reinvest the stock. That's what a lot of people do during their growth phase. And then a lot of people, when they're retired, choose to take distributions from their stock in the form of dividends. So they receive it back and they spend that cash. So it can be beneficial both ways. It can help build up your stock portfolio if you're reinvesting those dividends. And then when you want to start drawing income out of it, you can kind of flip a switch and start receiving dividends. So you'll see that this definition came from Investopedia. Investopedia is one of my favorite resources for general knowledge about investments. So you can search anything from stock dividends to stock option strategies, and you can find some good information on Investopedia, basic information on there. So I wanted to reference that. Here's an example. Again, not a recommendation, but I wanted to use an example of something that's recognizable for people. So this is an example using Verizon. So Verizon currently pays a 6.32% annual dividend. You can either reinvest or receive the dividends in cash, as we talked about. And again, this is an example, not a recommendation to buy, hold, or sell a security. But you might be thinking to yourself, well, hey, that's great. I'm going to run out and get Verizon. I like that 6.32%. That's a little bit better than I'm getting in my money market. You're probably today, here we are, May 16th, 2024. You're probably getting somewhere around 5% in your money market. You might say, well, that's over 1% better. I'm going to run out and buy some Verizon and get that dividend. Well, you got to be careful because pay attention to price. So here's what happened with Verizon. So this is from Google. I just Googled Verizon and looked at the stock price, and you'll see. Let me see if my laser pointer is working here. This is using a 5-year period. Well, 5 years ago, you said, "Oh, I'm going to start buying Verizon because I like that. I like that dividend that I get." Well, you haven't had a great experience. You've lost about 28% of your investment over the past 5 years. So I'm showing you that, again, not to recommend against buying Verizon or for buying Verizon. I'm showing that as an example because it's not all about the dividend. And you also have to look at the different time periods. So this is 5-year period. Now let's look at over the past 1 year. Here's the same company. We're looking at price because remember, you can grow your investment by dividend or price, or often a combination. But this is price. Over the past year, Verizon grew 2.77%. So that's just the price growth, 2.77% over the past year. So it really depends on what your objectives are, what your timeline is. Remember, when you're talking about stocks, this is money that you should not, you're not afraid to lose it if you invest, whether it's $100 or $1,000 in a company like Verizon, and it increases 2% and you get some dividend also, that's great, but it could fall. If it falls in price, you'll likely still get your dividend. I say likely because they can suspend dividends at any time. They can reduce or increase dividends. And when I say they, I'm talking about the board of directors. So now let's talk about, here's another example. So I wanted to find another stock that I thought people might recognize. I think most people recognize Apple. Trades under this symbol. This is what's called a ticker symbol. So you can just Google or search. I say just Google, but whatever search engine you're using. I've read that Bing's becoming more popular now because they have a strong AI component in their search engine. That's pretty interesting. But this ticker symbol here, this AAPL, and what we saw previously with Verizon, this is the ticker symbol, VZ. That's how these things are tracked on stock exchanges. So you've got this AAPL, and that represents the trading symbol for Apple. So over your year to date, you might look at this and say, well, geez, Apple's not a good investment. It's down 8.65% year to date. Well, you don't look at it in a vacuum, not just in a short period of time, because again, your stock investment should be investments you're going to hold over a longer period of time, at least 3 years plus, 5 years or more, but think even longer. So that's just year to date. So that's as of a couple weeks ago when I prepared this presentation. But let's look at Apple growth over 5 years. So over a 5-year period of time, we're at 241% growth. That's significant. So over the past 5 years, you had significant growth. So when you're evaluating the companies that you're looking to purchase, if dividend yield is important to you, and that could be important for your growth also, you might say, well, I want a company that is just based on price growth. And the reason a company like Apple doesn't produce dividends, or may not produce dividends, is because they're reinvesting in the company. A company like Verizon wants to give value to their shareholders in the form of dividends. So it's just a different strategy at different times in a company's life, or just generally a different strategy that a company may have. But look at not only the short term, but also look at the long term and see how it fits in potentially to your investment portfolio. And again, I just have to say that these are examples only, not a recommendation to buy, hold, or sell a security. So I don't want any folks, whether they're your grandchildren or a random young adult listening to this on YouTube, saying, hey, I bought Apple because you recommended it, and now I've lost money. That it is not a recommendation to buy, sell, or hold a security. So let's look at what would have happened using Apple as an example, because again, if you just go back to year to date, it might scare you, but you want to think about long-term strategies. So if you looked at Apple, and what I did is I went back and I said, okay, what was the price of Apple, or what was the average return of Apple over the past 20 years? And the average return of Apple over the past 20 years was 37%. That's the average return. It's had high years and low years, but that's an average return. So then I took the starting with a zero balance, and we invested $50 a month over 20 years. That's a total investment of $12,000. And if Apple earned, as an example, if Apple earned an average of 37%, how much would you have in value at the end of that 20 years. So let me just frame it again. You start at zero. You start investing $50 a month. In this example, Apple or any security that has earned 37% over the past 20 years. Your total investment over that 20 years is $12,000. Your value at the end of that 20 years is $2.3 million. $2,370,726.32. Exclamation point, exclamation point, because that's exciting. And the reason I wanted to point that out to you is that if we go back to these charts and graphs, it can be like, oh, well, some of them are up, some of them are down. I don't know what the heck to do. I don't know when to buy. Folks, it's about consistency. It's about consistency in your process. It's about consistency in your investing. It should be automated. It should be something that you do on a regular basis, and you should. You can do one of many, many different things. You can learn how to analyze companies and find an Apple or something that works for you. You can. I'm going to talk next week about mutual funds and exchange traded funds, but you can. There's a lot of different ways that you can figure out what to invest your money in, but the key is to do it consistently. So what I wanted to show you with this was $50 a month. That might be a little or a lot to you. I don't know. You can use your own number. The good thing is you don't have to have a financial calculator. You can just do a search. You can do it using artificial intelligence. I had a lot of fun using AI to put this presentation together. So you can use that artificial intelligence to figure out, if I only invest $5 a month, what does it look like? But many of you can find $50 a month to invest instead of spend somewhere. And I wanted to show you the impact of doing that over a longer period of time and what you could have in the future if you did that. So over $50 per month over 20 years, your total investment is $12,000. Your value is $2.3 million. I think that's exciting. So that is the program for today. Next week, we're going to talk about how to grow your money using bonds. And we're also going to talk about exchange traded funds and mutual funds. And we're going to talk about what they are. So I hope you found this Financial 15 helpful. This was a part 2 of a basic education course around some financial essentials for young adults. Again, last week we talked about banks and bank fees and interest and the cost of credit. In this segment here, we talked about basics of stocks and growing your money using stocks, whether it's price or dividends. And next week, we're going to talk about bonds and what bonds are. And we're also going to talk about exchange traded funds and mutual funds. So I hope that was helpful. If you have any questions, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you haven't already, hit that subscribe, like, and notification buttons. And I would appreciate the subscription. I appreciate the likes. And with the notification, you make sure that you're notified as soon as we release a new video. If you want to go through our website and see what we have on there, you can find us at attleborowealth.com. That's attleborowealth.com. That's it for today. I hope you all have a great week. If it's beautiful where you are, get outside, take a walk, and enjoy it. Take care, everybody. Have a great day.